When you think of Warren Buffett, you probably think of his genius for picking stocks. And you wouldn't be alone. People spend countless hours trying to reverse engineer his portfolio, desperate to find the next Apple or Coca-Cola. But they're looking in the wrong place. His real secret, the engine behind a $100 billion fortune, isn't about finding the next hot stock. It's a simple, unshakable mindset that lets him build wealth while everyone else is panicking. For decades, the world has been asking, what is Buffett buying? We should have been asking, how does Buffett think? The answer isn't buried in some complex financial model or insider trading report. It's in a set of principles so simple, they're almost deceptive. These aren't just rules for investing, they are rules for thinking, for acting, and for having the kind of emotional control that most investors can only dream of. So, forget the stock tickers for a minute. We're about to uncover the core philosophical secrets that guide every single decision he makes. To really get this, we have to go back in time long before Buffett was a household name. Picture it, 1963. American Express, a titan of finance, a company literally built on trust, is suddenly at the heart of a massive national scandal. They called it the Great Salad Oil Scandal. Here's what happened. A company called Allied Crude Vegetable Oil got huge loans from American Express, using its massive inventory of salad oil as collateral. The only problem? The tanks weren't full of oil. They were mostly full of water, with just a thin layer of oil floating on top to trick the inspectors. When the fraud got out, Allied Crude collapsed and Wall Street freaked out. American Express was on the hook for millions, and investors, terrified of bankruptcy, fled in droves. The stock price was cut in half. It was a moment of pure, raw fear. The herd was stampeding for the exit. But Warren Buffett didn't run. He did the exact opposite. He went to work. He didn't just stare at the stock chart. He went out into the real world. He walked into restaurants and banks. He talked to customers and merchants. He needed to know one thing. Had this scandal actually changed how people felt about American Express? And he saw that people were still using their traveler's checks. Merchants were still proudly displaying the American Express logo. The fundamental business, the powerful brand that lived in millions of minds, was completely untouched by the chaos on Wall Street. The business's value was still there, even if the stock price was screaming doom. So, while everyone else was panic selling, Buffett started buying. He invested a staggering 40% of his entire investment partnership into American Express. A few years later, the stock had soared, and his partners were rewarded handsomely. This story tells you everything. His success wasn't about a hot tip or a fancy algorithm. It was about a mindset that could separate the market's temporary emotions from a business's long-term reality. This story shows that the secret isn't about charts or trying to predict the next crash. It's about a set of simple, powerful principles that, together, create a fortress against the emotional chaos of the financial world. So, let's break them down. These are the 4 pillars that allow him to act with total clarity when everyone else is lost in fear and greed. Principle 1. You're buying a business, not a ticker symbol. This first idea is the absolute bedrock of the Buffett philosophy, and it's where most investors get it wrong right from the start. When most people buy a stock, they see a ticker symbol, APL, KO, AMZN, just a little blip on a screen that goes up and down. They're basically gambling on price movements. Buffett sees something completely different. He sees partial ownership in a living, breathing business. He isn't buying a stock, he's buying a piece of a company. This shift in perspective changes everything. You stop asking, will this stock pop next week? And you start asking, is this a business I'd be happy to own for the next 10 or 20 years? You start thinking like an owner, not a speculator. So what does that mean practically? It means you obsess over business fundamentals, not market noise. Buffett reads financial statements to understand a company's debt, its profit margins, its entire history. He looks for companies that have proven for decades that they can make real, reliable money. He's not interested in flashy startups with big promises and no profits. He's interested in durable businesses that have already stood the test of time. Think about his legendary investment in Coca-Cola back in 1988. He wasn't just buying a stock. He was buying a piece of a global empire. He saw a product that was simple, cheap, and loved by billions. He understood that the brand itself, that iconic red and white logo, was like a castle with a giant moat around it, protecting it from competitors. The daily zigs and zags of the stock price were almost irrelevant. He was focused on the value of the business and its power to generate cash for its owners, year after year. This mindset forces you to do your homework. It forces you to ask, how does this company make money? Who are its competitors? Does it have manageable debt? Is the management team honest and smart? When you adopt this view, you're no longer just a spectator hoping the market goes your way. You're a business owner. And the stock market just becomes a place where you can occasionally buy wonderful businesses at attractive prices. This one mental shift is the most critical step to moving from a gambler to an investor. It's about focusing on what's real, the business, and ignoring what's fleeting, the daily stock price. Principle 2. Mr. Market is your servant, not your guide. This second principle is maybe the most powerful mental tool in all of investing. It's a little story that Buffett learned from his mentor, Benjamin Graham, and it's the key to staying calm when markets are crashing. To get Buffett, you have to get the story of Mr. Market. Imagine your partners in a private business with a guy named Mr. Market. Every single day, Mr. Market knocks on your door. He offers to either buy your share of the business or sell you his. But here's the thing about Mr. Market. He's an emotional wreck. He's a manic depressive. Some days, he's euphoric. He sees nothing but blue skies. Business is great, the future is incredible, and he's giddy with optimism. On those days, he'll offer you a ridiculously high price for your share. Other days, he is completely despondent. He's drowning in pessimism and convinced the world is ending. On those days, he shows up, practically in tears, offering to sell you his share for pennies on the dollar just to get out. Now, here's the secret to dealing with him. He doesn't mind being ignored. If you don't like his price today, just close the door. He'll be back tomorrow with a totally different offer. You are never forced to trade with him. Mr. Market is there to serve you, not to guide you. His price doesn't reflect the real value of the business. It reflects his emotional state. The crazier he acts, the bigger your opportunity. When he shows up euphoric, quoting a sky-high price, maybe you sell your share to him. And when he shows up depressed, offering you a bargain basement price, you should happily buy his share. The worst thing you can do, and what most people do, is let his mood affect yours. If his anxiety makes you anxious or his giddiness makes you giddy, you are doomed to buy high and sell low for the rest of your life. This story perfectly explains the stock market. The market is Mr. Market. It's constantly shouting prices at you, driven by the collective emotions of millions. During the dot-com bubble, Mr. Market was euphoric. During the 2008 financial crisis, he was suicidally depressed. Buffett's genius is his ability to see Mr. Market for what he is, an emotional, unreliable partner who constantly offers you amazing deals. This is the mindset behind his famous quote, "Be fearful when others are greedy, and greedy when others are fearful." He's just saying, take advantage of Mr. Market's mood swings. By turning the market into this character, you detach emotionally. A market crash is no longer a personal disaster. It's just your business partner having a bad day and offering you a wonderful bargain. Principle 3, demand a margin of safety. If the first two principles are about what to buy and when, this third one is about how you protect yourself from being wrong. It's called the margin of safety, and it's the key to not losing money. Buffett explains it with a great analogy. When you build a bridge, you design it to hold 30,000 pounds, but you only drive 10,000-pound trucks across it. That extra 20,000 pounds of capacity is your margin of safety. It's your cushion against things you didn't expect, mistakes in your calculations, or just plain bad luck. The same exact idea works in investing. A margin of safety means buying a business for way less than what you've calculated its real, or intrinsic, value to be. After you've done all your homework and figured out a company is worth, say, $100 a share, you don't pay that price. You wait. You wait until Mr. Market has one of his depressive fits and offers it to you for $70 or $60, or if you're really lucky, $50. That gap, the difference between the price you pay and the value you get, is your margin of safety. Why is this so critical? Two big reasons. First, the future is uncertain. Even the best analysis can be wrong. A new competitor might show up, or a new technology could change everything. The margin of safety protects you from your own mistakes. If you thought the business was worth $100, but it turns out it's only worth $80, you're still okay if you bought it for $60. Second, it gives you the psychological strength to handle market swings. Downturns are going to happen. If you buy a great business at a fair price and the market drops 30%, you're sitting on a big paper loss. That can lead to panic. But if you bought that same business with a 40% margin of safety, a 30% drop might just bring the stock down to what you paid for it. That makes it a lot easier to sleep at night and ride out the storm. This is the ultimate act of investing humility. It's admitting you can't predict the future perfectly. It's a disciplined rule that tilts the odds heavily in your favor. It's how you set up a coin toss where heads, I win, tails, I don't lose much. Principle 4. Never invest in a business you cannot understand. This last principle is the one that demands the most discipline. It's called the circle of competence, and the rule is dead simple. Only invest in businesses you can actually, truly understand. Buffett famously said, "Know your circle of competence and stick within it." The size of that circle is not very important. Knowing its boundaries, however, is vital. This isn't about being a genius. It's about being honest about what you don't know. The biggest investment mistakes happen when people wander outside their area of expertise, usually chasing some hot trend they don't really get. For decades, Buffett was mocked for avoiding tech stocks. During the dot-com boom in the late 90s, while everyone was getting rich on internet companies, he just sat on the sidelines. He admitted openly that he didn't understand their business models and couldn't predict which ones would still be dominant in 20 years. People said he was old and out of touch. Then the bubble burst, and his discipline saved him from the catastrophe that wiped so many others out. He didn't avoid tech because he thought it was bad. He avoided it because it was outside his circle of competence. Your circle is built from your own experience and study. If you're a doctor, you probably have a deep understanding of healthcare companies. If you're a software engineer, you might get tech business models better than most. The key question is, can you explain, in simple terms, how this company makes money, what its competitive advantage is, and what it will probably look like in 10 years? If the answer is no, you have no business owning it. This principle is a powerful filter. It instantly clears away 99% of the so-called opportunities out there, letting you focus on the few things you can analyze with real confidence. What's really interesting is that while he insists on staying inside his circle, he's also constantly working to expand it. He spends most of his day just reading and learning. His massive, later investment in Apple is the perfect proof. For years, he saw it as a tech company outside his circle. But over time, he began to see it differently, not as a hardware maker, but as a consumer products company with an insanely powerful ecosystem. An ecosystem that looked a lot like the other powerful brands he understood so well, like American Express. He only invested after he felt Apple was firmly inside his newly expanded circle of competence. Sticking to what you know is a profound act of intellectual honesty. And it's the final pillar in a mindset that chooses safety and long-term thinking over short-term excitement. So, what is the hidden secret to investing like Warren Buffett? It's realizing that real wealth isn't built by reacting to the market's every whim. It's built by having a philosophy that holds steady. It's a mindset built on 4 pillars. 1. Think like a business owner, not a stock gambler. 2. Treat Mr. Market like an emotional servant you can take advantage of, not a guide you should follow. 3. Always demand a margin of safety to protect yourself from the unknown. And 4. Be brutally honest about what you know and stick inside your circle of competence. These aren't complex financial formulas. They're timeless principles of rational thought. They build a fortress of discipline around your mind to protect you from the single greatest threat to your wealth, yourself. The real secret to Buffett's success isn't in his stock picks. It's in a philosophy that is available to every one of us if we just have the discipline to use it. If this way of thinking about investing makes sense to you and you want to learn more about building real, long-term wealth, subscribe for more videos. We're here to help you tune out the noise and focus on what actually works.